Good morning, America.
Good morning, America.
This is your co-host, Evan Kai.
This is Jason Lipinski.
And the weather is pretty nice today, as you can see, but screw that, we're going to go straight into the economics. So a year ago, inside the 2015 business cycle, we are in the late stages of the contractionary and very beginning stages of expansionary.
So on your right, you will see that this map shows the different states going through the business cycle. That's pretty.
And so some indicators. So energy is up. The index is up 2.4%, and all other major components of energy are on a decline. But we have the food index coming up 0.2%, and we got all-around index rising about 0.7%. So as you can see, we're in the expansionary. We're rising up. That is 0.7% up, as you can see right there. And that's over the past 12 months inside 2015.
So should I go into mine? 2016?
Yeah.
All right. So the all items index rose up by 0.9%.
Wow, that is expansionary.
It's like, and then the index for all items less food and energy has risen 2.2% over the past 12 months. That's a big progress.
That's progress.
And we see it in the past couple of years.
That's
right,
really
so
good.
let's go
nice
talk-
job, Obama.
Let's go talk about some fiscal policies.
Oh, fiscal policies. All right. You can start off with that with 2016
fiscal
We can get the
policies?
fiscal policy.
Oh, okay. I will love to talk about it. All right. So in 2016, we're in expansionary.
Expansionary, yes.
We made the largest investment in clean energy in our history. We're making history.
Wow, we're making history here. Obama is making history, folks.
Okay. All right there. The budget includes tax cuts for middle class and working families that will make paychecks go further in meeting the cost of childcare, education, and saving for retirement. And that's basically 2016 fiscal. That's how it is.
So we're looking for the fiscal year of 2015. We're looking for more efficient tax code to create jobs in rebuilding our roads and bridges and unclogging our commutes and transporting goods made in America. So we're looking we're spliffing up America and we're making it nicer down here. And
we are.
yeah, so we're making some infrastructure. We're adding jobs. We're getting stuff done. We're adding to the economy, and we're trying to reboot the economy by giving a lot of people jobs. And we are cutting taxes down just a tiny bit this year. And I think that's all it is for the fiscal policies of 2015. If you know what I'm talking about.
We got one more.
Jason.
We're talking about the
monetary policies. Forget about that. We're on economics.
All right. So 2015. What you got?
So I think we're gonna start with 2016 first. On this one.
Wow. Okay. So we're in expansionary. Again.
Wow.
We're going up.
Nice
We're
job.
improving.
I can't say it enough.
So we raised the target range for federal funds rate by 1/4 percentage point after 7 years in which the rate had been held near zero.
Wow.
Zero.
Nice. Is that that's okay. So
there's one more.
one more. Sorry.
I was reading through my notes.
My bad,
I messed
cut
up.
me down. All right.
It's all good.
Yep, that's
the
all
goal
good.
is to keep inflation around 2%.
2%. That's pretty good.
That's one more than one.
So nothing much changed since 2015. We're trying to keep it below 2% inflation. So how are we doing this? Someone may ask. Well, we're trying to make interest rates low and keep inflation low. So there's still economic growth, which means it's expansionary. And because of this, people will keep spending their money. Versus if we up the inflation or didn't do as many taxes, people could get scared and take away their money. We're not doing that that year, folks, because we're in 2016, but we're not doing that in 2015, and we are in the expansionary stage, ladies and gentlemen.
So now to our reporters in the field, who will tell you about the 2011 and give you an overview. I'm Jason Lipinski.
This is Devin Kaya. You just watched Economics News.
Economics.
The inflation in 2011 was very low, with an average growth of 0.28. It was a cost-push inflation, and it was caused by a couple of key things, all stemming from increased cost of production. One key factor in the cost of production is the price of gas. The gas prices in 2011 were on average $3.20. Gas was still rising steeply throughout 2011, which would have driven up transportation costs, something that would have affected the prices of nearly everything. Obviously, gas has a very inelastic demand too. Another cause of rising production costs would be increased costs of labor. In the Fed's economy overview of Boston, it stated that the demand for permanent to temporary permanent hiring continues to grow. Indeed, two contacts report that permanent placements are up more than 20%. Relative to last year. As labor demands go up, companies would have to offer a more competitive wage to their employees. Along with more full-time positions needing to be filled, the companies paying those new salaries would have to pass on extra expenses to consumers. Looking at the federal budget, it seems like the Fed was using expansionary fiscal policy in order to try and stimulate movement in the economy and continue growth as we emerged from the recession. Specifically, they talked a lot about growing small businesses in order to grow the number of available jobs. However, on the alternative, they seem to be lowering taxes, especially for the middle class. In the 10 months since Recovery Act was signed into law, the administration cut taxes for 90% of working families through the Making Work Pay tax credit, which amounted to $37 billion in tax relief for 110 million working families over that time period. The Fed is going to try and cut wasteful spending too, so that was a big part of their goal. Looking at monetary policy, mortgage rates were at an all-time low. Throughout the second half of 2010 and early 2011, the FOMC maintained a target range for the federal funds between 0 and 0.25% and reiterated its expectation for the economic conditions, including low rates of resource utilization, subdued inflation trends, and stable inflation expectations were likely to warrant exceptionally low levels for the federal funds rate for an extended period of time. In August 2011, Treasury bonds yields dropped as low as 1.99%. The previous record was 2.03%. Treasury prices were pushed up and yields lower as stock markets around the world plummeted. The stock sell-off was triggered as a series of disappointing economic reports and a gloomy outlook from Morgan Stanley renewed fears about the slowing global economic recovery. Surveys of households suggested that the public's long-term inflation expectations also remain stable.
With these rates, there's an average for each year, and since 2011, they have been decreasing. An economic guess would be if the low rates keep happening, then they will jump in amount and catch everyone off guard. This could affect the market because when the rates start to increase, the cost of goods and services increase. It will affect the amount of money people will have. Those hard-working Americans will still get paid what they were getting paid, but the inflation rates will rise prices that will make people have less money to spend.